Okay, good afternoon, everyone, and welcome to our webinar comparing South African investment property versus its offshore primary currency equivalents. For those that don't know me, I'm Mark McAllister, Senior Partner for Holborn Assets based here in Cape Town, and I've been helping returning South Africans and South Africans domestically here to diversify their investments globally into the best investment asset classes around the planet. So please feel free to connect with me on all the social media channels that you see on screen now, and you'll receive the latest updates on what we're working on and where we think is the most appropriate and best in case investment cases, particularly on the investment property side that we're talking about today. There is a section at the end for answering questions, and I would request that you utilize the Q&A button. You'll find it in the center of your screen on Zoom now at the bottom, and feel free to type a question along the way, and we'll do our best to answer them all at the end. So thank you very much to everyone for taking part. So at Holborn, we're very fortunate to have a panel of about 12 different developmental partners, and I'm joined here today by two of our UK property investment specialists from a company called API Global. So good morning, Dane and Shelley. Thanks for joining us today. How are you both?
Morning, Mark.
Good morning. Thank you, Mark.
Okay, excellent. Let's now get started. So to give you some background about our company, by way of introduction for those who don't know us, Holborn Assets is the second largest independently owned financial advisory business globally. We've been around since 1998. And we manage and administrate nearly $3 billion in liquid funds for nearly 20,000 clients globally in about 30 different countries, from offices in 11 different locations around the world. We specialize in helping expats with their finances. That's where we started. And in particular, those who've worked in the UK that are resettling to their home countries, like South Africa, as well as helping now South Africans who want to diversify some of their wealth out of South Africa into maybe some more safe and secure global jurisdictions. So in South Africa, we have offices in Johannesburg, we have an office in Durban, a new one in the Winelands, and then obviously Cape Town, which is where I am senior partner for the group. So before we get started, on screen now are probably the top 5 questions I'm asked about, particularly UK property investments. So there are things like, how do we go and get a mortgage or remortgage from South Africa? What are the loan to values that can be expected? How do I make sure that I rent this thing out? Is now the time to invest in UK property, with the rand as strong as it is? And what are the investment hotspots of the future? And look, you may have heard, certainly you'll be able to answer these and many more, and we'll encourage our viewers to ask those questions as we move along. So why should you consider owning an investment property? Look, I'm a firm believer in investment property. I've been a landlord down the UK for over 20 years, both residential and commercial. And you may have heard of plenty of examples where your friends, family, or colleagues have established a property investment portfolio over the years. And some people have actually gone on to make millions in investment property, millions of pounds, not just rands. Now, the reason is because it's one of the few asset classes that you can actually borrow money against, and using other people's money to multiply your growth and profits is something, an asset class that we call safe as houses. You've probably heard that expression before as well. So today we're going to show you how you can double your money in investment property. But before doing that, we have to look at where in the world you could invest. And to answer that question, is the UK the best property investment case? And if not, what should influence your thinking when you're starting to look at all the investment cases around the world? So I'm very fortunate to have one of the largest expat client bases in South Africa. So there's two types of expats that I help with overseas investments. Firstly, there's Brits like me living in Africa, but most are South Africans who went to the UK in the 90s and the 2000s, and then they're coming back home. Maybe you're one of those now thinking about coming back shortly. But that's not what I mean by this slide, actually. I've got two types of clients when it comes to primary currency investment property. The first group are those who lived and worked abroad in places like the UK, and they kept their property and have rented it out. The second group, the more upset one on the right-hand side, are those who wish they'd kept it after selling it and bringing all of that money back to South Africa. But South African property is better, right? I hear this all the time. There's bigger returns, or it's easier to rent out. All those kind of points. Maybe not so much, to be fair. I think certainly when I first arrived in South Africa, everyone was saying to me, look, you must invest on the Atlantic seaboard as an example. And the property prices have adjusted significantly downwards since then. But look, my objective brain really stands back and says, look, like any asset class that we deal with, I need to be able to answer with facts, which is better, So let's have a look at those facts and back it up with some data and see what a true comparison on the world stage of those asset classes against, for example, UK property as a benchmark. So if we have two countries to consider, we must start, first of all, with understanding the journey of two currencies. And also that impacts on things like the cost of leveraging and debt. So here we have, the currency pounds versus rand over the last 40 odd years. And you can see that the rand has depreciated significantly from about 1.8 to 1 to now about 20 rands to the pound. It had a bit of a flick up to nearly 25 rands not too long ago. But look, the underlying trend is only going in one direction. In the last 40 years, the currency's depreciated by 1,200 odd percent. So let's put that in real world numbers. If you bought £1 million worth of pounds in 1980, you would have got £540,000. And in 2020, today now, current exchange rates, £1 million will get you £48,000. So let that just sink in for a bit. I think there's a misconception that this depreciation happened only during the Zuma years. That's incorrect. You can see here that it's been slowly depreciating for decades, around about a 5% a year figure because of inflationary pressures. When you look at the US dollar rand rate, the picture's the same. So with things like the credit downgrades, the various bailouts, corruption, it's reasonable to assume that the rand will continue on at least the same trajectory against primary currency where it is now. And that's that dotted line, and probably continue along that dotted line for many years into the future. So the question you have to ask yourself is it going to stay the same? Do you think it's going to get worse, or do you think it's going to get better? And that's the gut feel that should drive you to thinking, where I should be putting my money globally when it comes to investing in property. So let's now benchmark average property values. So the dark blue line here is the average UK house price in pounds sterling. The lighter blue line is the average South African price, but converted into pound sterling at the appropriate exchange rate at the time. So the red line shows what happened after Brexit. I get this is quite a common question. Surely the market went down. Well, as you can see, the answer is no. UK house prices haven't missed a beat and continue to rise during the structural undersupply that's present in that very small island. They simply aren't making any more land. Let's then flip that over to the rand equivalent. But what you see is the same story, but with the odd opportunity to take advantage of a relatively strong rand. So post-Brexit was a great example. And now recently, again, we've seen the rand strengthen. And it's kind of what we refer to as a bit of a tango currency. It takes one step forward, two steps back. So when we get times where the rand is strong like now, it's absolutely the ideal time to be considering a move into a primary currency. But look, the overall story remains, a high inflation economy and relatively large amount of land South Africa, 50, 60 million people in both countries. The differences between South Africa and the UK is all of those people in the UK are crammed into a size of the Western Cape. There's very stringent planning laws, green belt, that sort of thing. So supply and demand imbalance in the UK is also in your favor, as well as things like inflation that we've talked about. So, okay, we've sort of discussed the option of South Africa. So if it's not going to be in South Africa, if you're going to start to diversify somewhere else, and particularly not in the Rand, where should we be looking for our investment property opportunities? So as a global wealth defense specialist and an investment manager, we need to consider and filter out all the options around the world. So let's imagine we sort of zoom out to this sort of Google Earth view of the world. And what we need to do is create some filter questions to decide where we should be investing. So our first stop is to talk about currency. We've already touched on this, but we want to be protected as best we can from rampant inflation and a devaluing currency. So the only option really is to look at primary level currencies. So what do we mean by that? Well, there's the big four. I've only got three on this graphic, but what do we mean by that? It's pound sterling, US dollars, euros, and to a certain extent, Swiss francs, Aussie and Canadian, New Zealand dollars, that sort of thing. So look, simply put, if we've got a currency that starts with an R, okay, the likelihood of a rand, a rupee, rubles, anything like that, we discard it at this point. So what we're left with on our Google Maps view of Earth is something that looks a little like this. So, we've got North America there, Europe is there, Australia, New Zealand, etc. Now, the next 2 points in our triangle, our filter question, really are linked to the government of the day, in the country that you're thinking about investing in. So firstly, is there a risk of expropriation with or without compensation like there is in South Africa? Well, we would prefer that you only invest somewhere where the government will vehemently protect your property ownership rights. So this knocks out some of the more left-leaning or socialist governments, such as Spain as an example. They expropriated a whole beachfront in Marbella a while ago. So linked with that, what we want to know is that will you as a foreign landlord be taxed any less favorably by an overseas landlord? If so, we'd rather you focused on destinations that are attractive to overseas investors, without any punitive tax barriers to entry just because you're a foreign landlord. So look, with these three simple questions, our Google Earth Maps view of the world has reduced even further. And what we're left with really is just 4 countries in Europe. And those countries are Portugal, the Republic of Ireland, and the United Kingdom, and Germany. Look, if we were looking at land investment opportunities, I'd also include the USA, but that's a separate conversation. As you see, our primary focus on today's discussion with the guys with API is on property that's owned and then rented out, and our focus really is Western Europe. So 3 of those solutions offer euro-based investments, and one of them, the United Kingdom, is in pound sterling, which is widely perceived as undervalued post-Brexit and even in today's post-COVID world. So again, there's another tick in the box for the UK there. So look, now that we've narrowed down to 4 countries, we have to look at the age-old property investor's trick, okay? And what is that? Well, what you need to do is follow, investigate, and do research and try and preempt infrastructure spend. So, whether it's the man that stood in a windy field in West London and what became Heathrow Airport, or the derelict docklands that transformed into the sort of powerhouse and financial centre that's Canary Wharf, property investment has always followed infrastructure spend. So the gains made by those who invested before Crossrail, as an example, was built across London, saw significant gains above average in recent years. So my logical brain then says, right, where is the biggest infrastructure project in Europe? And is there an overlap on any of our shortlisted countries? Well, the answer is yes, there is. And it's the £106 billion behemoth project that is the high-speed rail link between London and what's called the Northern Powerhouse. I'm not going to steal too much thunder of the guys that are coming on after me. But look, right now, South Africans have the opportunity to be in the leading edge of an investment by looking at properties in this Northern Powerhouse project. So let me put some context to some meat in the bones, as it were. So I'm from a place just outside of London called Guildford in Surrey. It's about 40 minutes on the train from London, and an average 2-bedroom apartment there. It's about £400,000 currently, so quite a significant investment. So once high-speed rail was in place, that 2-bedroom flat in Birmingham that's currently worth the same, you pick up the same flat from Guildford and you put it in Birmingham, it's about 250, maybe £275,000. And the travel time that's currently an hour and a half will reduce down to about 40 odd minutes. So effectively what we're saying is Birmingham is going to be almost like a suburb of London in about 6-7 years' time by the time the project's completed. I'm not saying that property is then going to be worth £400,000, overnight. That's not what I'm saying. But, will it realistically outstrip the average? Will it be growing at a very conservative, say, 5-6% a year? Absolutely. And that's what all of the research agencies from the likes of Savills and JLL and CBRE are saying. It's a reasonable assumption to make. So now that we've sort of got a bit of an idea of what region we want to be in, let me let you in on the last of the property investors' tricks, something I'm sure you'll have heard of if you're interested in investment property, and how to multiply your gains using other people's money. This concept was made very famous in the book Rich Dad, Poor Dad by Robert Kiyosaki. He's a huge fan of investment property and using leveraging, which is basically mortgages, as they're called in the UK, or bonds as they are down here, to multiply your profits and gains. But unlike in South Africa, where you might be paying sometimes double-digit interest rates, the interest rates in the UK are significantly lower. So I'm going to just talk through a bit of an example here before I hand over to the guys from API to give us a little bit more of a nuanced case study. So now that we've found what we think is the best business case for property ownership globally, let's take two brothers or sisters, okay, who decide to buy an identical property. And let's say it's the £250,000 Birmingham example that we're going to talk about in a bit. So if you've read that Rich Dad, Poor Dad book already, so this is pretty much the punchline to that book. So how do you grow your wealth using other people's money? Well, let's say the first brother pays for it in cash, £250,000. Say it grows to be worth about £325,000 in 6 years' time. So as you can say, he's made a profit of £75,000. But let's not forget, he's also enjoyed the rent that he's generated, which is estimated about £1,000 a month, £12,000 a year for 6 years, or about £72,000 in total. So his profit gross is £147,000 on that £325,000 investment. So about a 59% return, which is pretty good. Now, the second brother decides, or sister decides, to leverage that investment. So instead, what he does is put down 30%, which is about 75% of the purchase price, and instead borrows the money from a UK bank, which are currently at the lowest interest rates in history for the rest. The same growth applies. He uses the same rental money to pay for the mortgage. So his profit in this example is £75,000, but on an initial investment of only £75,000. So that's 100% return. So if you've ever wondered how do people become millionaires through multiple investment properties, this is how it's done. And you could do it too. And you could do it from the comfort of South Africa. Now, over to Dane and Shelley. They're going to talk us through a real-world case study and update us of what's going on in the property market on the ground in these investment property hotspots in the UK as we speak. So, Dane, it's over to you.
Brilliant. Thanks, Mark. Really do appreciate that. Yeah, so I think just following on from your example there, I thought it was great for us to just look at this in sort of real terms. And we've used an example of one of our developments in Birmingham called Apex Lofts, and we'll go through that development in a little bit. But as you can see, it really supports the example that we looked at above. So on the left-hand side, we see an option where the brother or sister has used leveraging, and on the right-hand side, we can see sort of the straight kind of cash investment. Now, one thing we also aren't factoring in here, these are just kind of comparisons of this investment, but there's also an opportunity cost of investing the full £250,000 into one development. So a lot of what we talk about is diversification, and by being able to actually taking your £250,000 equity, maybe spreading that across 2 or 3 properties in various geographic locations or other asset classes, you're actually able then to build a stronger sort of nest egg. So as we run through this example, there's 2 sort of key differentials that we have. So when you look at your overall net returns, leveraging is always going to increase your return. So we can see, again, very much in parallel to the example we've seen above, it's about doubling your return on equity that you've invested. And you look down below in terms of sort of where we stand from a cash flow perspective. So in this example, the property is about £280,000. We've taken a 70% mortgage at about 3.75% interest. And this is an off-plan option, so your cash flow has been slightly split between current and completion date. But what you can see in terms of your cash flow position is that our monthly income is covering our mortgage costs. So essentially, our income is covering our monthly expenses plus our mortgage outgoing, and we're sitting in a cash flow positive position. So that's obviously the first thing that we want to look at when we're leveraging, especially when we're looking at offshore investors that don't want to be putting brands into their pound properties. So it's very important that we run these cash flow analysis to ensure that the various options that we're looking at for clients are cash flow positive. Now, that cash flow positive obviously then brings an income into the property, and that's factored into your overall returns. So 132% return over a 10-year period is a considerable sort of return on investment if you consider that. Okay, Mark, if you go on to the next slide, please. Now, another question that we get asked a lot when investing kind of offshore and particularly on off-plan developments is understanding, if the client's capital or the deposit that they've paid on a property, is that money actually working for them, or is that money now just being tied up into a development and sort of just sitting there? So when we look at this Apex Lofts example, you can see here that the development comes with a 20% deposit, which is about £50,000. Now, what we need to consider is during the build period, one of the benefits of buying off plan is you're actually buying in today's value for what's going to be a future product. So you're essentially buying something at today's price point that's going to be completed, let's say, early next year. So you're going to get capital appreciation because the market hasn't stopped moving. The market is still appreciating. So you're actually going to get capital appreciation on that unit. Now, you've only put 20% down deposit on the unit price, but you're getting the capital appreciation on the full value of the property. So if you take a 5% capital appreciation on that £270,000 scenario, that's around a £14,000 increase over a year period. So your future value is now sitting at around £290,000 at completion. So if you look at your return on your equity, you've only put £50,000 in, it's about a 25% return on your equity invested. If you had to take that same amount and put it in, say, the bank, or if you had to put it in the markets and investments at the same 5% appreciation, you can see obviously your return is going to be around sort of 5%. So that's again kind of supporting that kind of leveraging model in utilizing, being smart about, looking at these off-plan opportunities, and then also, tying that into kind of the overall leveraging opportunities that property brings. Okay, Mark, next slide, please. So where are we currently in the UK and sort of what's happening with pricing? So one of the fundamentals that we've discussed earlier today was the supply and demand imbalance in the UK. And as Mark pointed out, the UK is an extremely small geographic location, but the population is increasing. So the ONS is expecting the population to increase over 70 million by 2026. Now, that obviously presents challenges for the housing market. And there is a sort of what's been dubbed as a housing crisis within the UK by the UK government, something like 300,000 homes needed per annum to be delivered. Now, obviously, with the restrictions that Mark discussed about, actual availability of land, the Green Space Protections Acts within the UK economy, you can see why the fundamentals have bucked any sort of market fluctuations like Brexit and like COVID to continue to sort of perform and outperform other asset classes. So here we are, these are all current, articles that I picked up in the news recently, all kind of highlighting the sort of the strong performance of the UK market. We saw quite a strong growth post the first lockdown in the UK, because what we had was this pent-up demand where transactions were initially not able to proceed. And then that's all sort of come back into the market. So you can see here strong growth in the UK, sort of back to kind of those 2004 levels, 2011-12 levels, where we're seeing double-digit growth in certain postcodes. So our job here is now to take, looking at this as sort of layers of an onion. So Mark's described how we sort of start initially in looking at geographically worldwide, currency legislation. Now, what we do is we've peeled off those initial layers, and now we're in a stage where we know the UK is a strong market. We know it's performed historically well. Over the last 50 years, average house prices have doubled every 10 years, which is only around an 8% per annum growth rate. So we now kind of need to peel off those onions again and look at, where are the locations within the UK that are going to potentially be outperforming the average, because that's where we want to be positioning ourselves. So a big part of what we're doing is, again, sort of taking, from the macro right down to sort of the microeconomic factors that are happening in and around these regions. So Mark, if you just jump onto the next slide. So today we're going to be focusing on Birmingham as one of the key kind of destinations. There's a lot of happening in the UK at the moment, which I'm not sure everyone's kind of aware of, but there is significant infrastructure spend being supported by the UK government across the regional cities. A big part of this is that the UK government is trying to decentralize their economy outside of London. They're trying to diversify the economy, and through that is they kind of kickstarting all of this through this infrastructure spend that they're committing to these regional cities. Now, there's going to be some certain winners in this, and there's going to be losers because of where the sort of investment lies. So our current winners that we're backing at the moment is Birmingham, Manchester, Liverpool. So you've got Birmingham in the Midlands, and then you've got Manchester, Liverpool in your sort of your northwest. Birmingham has such a fantastic investment case, which is what we're going to focus on today. We don't have enough time to do everything because honestly, there is so much happening in the market at the moment, which is essentially driving a lot of this investor confidence into the UK. So if we look at kind of focus down on what is the infrastructure spends that's happening within Birmingham, and what are the key infrastructure spends and locations that are driving growth within Birmingham. So if you looked at Birmingham 2010, not too long ago, we're talking 11 years ago, people would have thought you were mad if you're talking about investing in property in Birmingham. We've seen a real insurgence and growth in Birmingham since the sort of the post-global financial crisis. And a big part of that was this sort of big city plan that came into play with the Birmingham City Council. Essentially, what they're trying to do is grow their city centre core by about 25%. They're going to pedestrianize all these sort of public realm areas. But what that's going to be doing is, it's creating quality office space for companies to be migrating into Birmingham and take advantage of the infrastructure that's going in. It's going to be obviously creating jobs. It's going to also be contributing significantly to the economy, all kind of growing the confidence in that. Off the back of that, obviously what we're seeing is population growth happening in this area, the right demographic of population, which is going to be the sort of your employable demographic, those sort of 24 to kind of 35-year-olds that are in the rental market, and it's obviously just growing the city. So residential property is obviously benefiting off the back of that. So if we jump into the next slide, you'll see essentially the extent of this investment. We're not talking about one or two buildings. We're talking 600 million pound, 500 million pound, 1.5 billion pound mega projects that are essentially changing the landscape of Birmingham city centre. So the New Street Station was completed. It's that stunning architectural phenom, which is, if you look at any kind of skyline photos of Birmingham, you'll see the big silver structure. We've got Paradise Birmingham, which is a key link in sort of the commercial real estate space within Birmingham. It's really where a lot of the financial housing is. You've got the likes of HSBC, Deutsche Bank, a lot of the financial services, which employs about 120,000 people in Birmingham. But what's interesting is a lot of those services and businesses have migrated out from London. Now, the benefits for a lot of these companies doing this is obviously the cost of living and the cost of doing business in Birmingham is about a third or a quarter of that of London. So you can imagine how that impacts your operational profits for a business. You also have access to over 75,000 students in some of the top universities. So you think about your sort of talent pool for these businesses, and you think about geographically, Birmingham sits very much central in the UK. You have access to 95% of the UK within 4 hours drive. Now, that's obviously all going to be improved with this infrastructure project, such as the HS2, where that's going to drastically reduce those travel times. So a lot of businesses are thinking about, how the future economy is going to work, where they want to be located in the UK, and Birmingham is certainly coming out on tops with a lot of those businesses. Now, again, what is that doing? That's driving up this demand for quality residential property. So a lot of people moving from London are expecting a certain quality, they're expecting a certain level of development, and that's what we are now looking at providing within Birmingham to house this new growing population. Okay, Mark, if you jump on the next slide. So this next slide is a video that's going to give you a bit more detail on the specific improvements or station that's happening within Birmingham, the Interchange Station. And the Interchange Station is a critical part of the HS2. It's the first station that's going to be built along the HS2 route, which is going to be around 2027. So for us, I mean, that's really going to be the sort of the key or the most beneficial for this project at the moment. And you're going to see how this is going to affect the economy. It's going to see what kind of is going to be built off the back of this HS2. And then we'll take a look at some of our developments that are in and around this sort of growth corridor around this HS2 and this big city plan that's happening, and how these are well positioned to really benefit from the long-term capital growth. Mark, just for the sound of the video, you might have to just go onto the share toggle and just allow sound.
Brilliant to be here in Solihull today to see this bridge move into place, because what this says to everyone is HS2 is for real, and most importantly, it's creating jobs right here in Solihull and the rest of the West Midlands right now.
Right from the outset, the Midlands have understood the importance of HS2 arriving here to Solihull, placing it at the heart of the nation, at the heart of the national and the regional network. And we always have made the point of the importance of integrating HS2 locally and regionally. And from a Midlands Connect perspective, what we're seeing today is exactly that.
HS2 will bring many economic benefits to the borough of Solihull, including job creation, but will also mean environmental benefits due to releasing capacity on our road networks and also on our freight networks.
For Solihull, HS2 has some tremendous gains, some tremendous benefits. From an environmental point of view, there's a great deal of work being done, but also from the business creation. Where we are now is going to be the site of an economic zone, next to the airport, next to the NEC and the international station.
For Solihull, the benefits are even greater really than anywhere else. If you think that the Interchange Station is going to be the first stop on the line as you come out of London, the amount of construction that is taking place now, and as I say, with the Solihull region being right at the centre of that, is brilliant for creating jobs, new opportunities for people, and I think it's a very, very exciting time.
We're one of the best connected regions in the UK. The new HS2 Interchange Station just across there will be at the centre of this new place, which will see offices, manufacturing centres, a healthcare innovation campus, as well as many homes to enable further growth into the 21st century.
So, there's been a lot of talk in the news about, HS2 is a proceeding, isn't it? So, that's a great way to kind of just show you that, it's under construction, it's underway, and, Birmingham Interchange Station, and then obviously Curzon Station, Birmingham's got 2 stations in it, are really going to be sort of at the forefront of the benefit of this. So what you see on the screen now is an overview of kind of some of the key locations and some of our developments within Birmingham. So if you look in the top left-hand corner, you'll sort of see the city centre, Birmingham city centre. You'll see the HS2 Curzon Street station. So that's where your big city plan is happening, and that's where you're seeing a lot of the regeneration of the city centre core, and we're seeing obviously significant investment and growth within that. The other key area that was mentioned in that video is, if you look in the middle right, by the Birmingham Airport. So the Birmingham Airport is and surrounds is part of an overall regeneration scheme called the Hub. In total, it's worth about £4 billion, but essentially it includes expansions to the airport, adding additional runways. You've got the NEC National Exhibition Centre that has about 500 exhibitions a year, attracts about 6 million visitors per year. You've got Birmingham Business Park, employs around 8,000 employees. You've got Land Rover Jaguar, which is a major employer within the region. And now you've got HS2 Interchange Station and all the development that's happening in and around that. So for us, we've seen an opportunity, and we're actually fortunate that we've had a number of developments complete in this, what we would look at sort of this growth corridor that sits between the city centre of Birmingham, which is getting all that investment, and this sort of the hub air location, which is by the Birmingham Airport. So our developments that we've completed, Sheldon Court and Interchange, that sit, you can see just in sort of towards the centre line, have performed significantly well. They've both reached completion, they've both fully tenanted, and the interchange for us was, a simple office conversion, residential property, nothing fancy about it, and it's really outperformed our rental estimates on the market. So, it really speaks volumes to this location in terms of an investment. The good news is, we're still sitting, like Mark mentioned, in this location, 1 bedrooms, in our development at Swan Court, sitting around £160,000, 2 bedrooms up at £200,000. Now, again, when we talk about proximity to that HS2 station, when we talk about that sort of commuter belt London, you can see the potential for growth here, but also, great value for us in terms of value for rands invested. As you go closer towards city centre, your sort of apex Lofts location, you obviously start to get into more kind of city centre pricing. So your 1 beds are going to start around 220, and your 2 beds are going to go up to about 280. So yeah, I mean, Mark, if you want to drop down, we can run through the developments to give you guys a bit more perspective of, not just location, but the actual developments themselves. So Swan Courtyard is our newly launched development in Birmingham. You can see we have a big focus on Birmingham. We've committed strongly to the location based on this investment case that we're looking at, and the amount of kind of infrastructure spend that's happening. So we've seen a lot of value recently in these sort of more borough locations outside of city centre, particularly post-COVID, where people are looking for more space, they're looking for access to green areas, but still having, a 10-15 minute drive commute into city centre. So you're not sort of out in the sticks where it's going to take you an hour or 2 to get to city centre. You're actually extremely close by. And if you live in South Africa, I think a 15-minute drive into the CBD is considered a very short location. But here we are with this development sitting, at extremely good value. Prices start at £130,000. And if you go on to the next slide, Mark, you can have a look at, the interiors, the quality. You'll notice with all our developments, as I say about us taking the layers off the onion, I mean, it really goes down to from the location to the development, right into the specifications and the design, because that's what we're looking at in terms of differentiating our developments with competing buildings to attract the right tenants, making sure that the right quality specifications are in, because this is an investment property and we want things to last. We don't want to be replacing kitchen cabinets in 2 years. That deteriorates our returns, obviously. We don't want that headache for international clients. So a big part of what we do is really getting into the detail also of the specifications. So you can see lovely designed units. You can see in the top left corner, you've got the green sort of spaces out there, which is in extremely high demand. These locations also just outside of city centre, Swan, Solihull, they also have fantastic access to the likes of schools. You know, their town centres are sort of fantastic. So this is a great sort of option for someone who's looking to sort of step onto the ladder, you know, really affordable and a great investment case in terms of, you know, the location between those two really big sort of hotspots. All right, Mark, the next one. Right, so Apex Lofts. This is sort of your more city centre location. Its location, Digbeth, is essentially earmarked as sort of like the Soho of London, right? So it's going to be the creative district of Birmingham. Birmingham's got the youngest population in the UK, so it fits really well with their demographic. There's significant regeneration happening in the area. You are 5 minutes from city centre, but you're also, where this particular development is, 500 metres from Curzon Street Station, which is the HS2 station. So again, if you think about these big infrastructure spends and who benefits from it, generally it's those properties within a 600-metre radius of the sort of the access to the trains. But what we haven't discussed is also some of the small infrastructure spends happening within Birmingham. So there's also light rail, bit of a tongue twister, network coming into play, which is going to connect with HS2, but also into the financial district and city centre of Birmingham. Again, kind of solidifying their commitment to having a pedestrian-friendly city core. So your access to public transport and to infrastructure spend, but also general regeneration in this area is fantastic. And then also being in sort of that more city centre location. If you go on to the next slide, Mark. So for this, again, you know, you can see very high quality design. This project is under construction. We're actually just completed the structural frame this week, which is a fantastic milestone. But you know, this again, it's got all your kind of amenities with your rooftop garden, your rooftop gym. The design on this development is fantastic. The size of the units is very spacious. So you know, this for us is a great sort of city centre option. As I said, your one bed's around £220,000 and the two beds are around 280. We also have executive sky lofts, which is a fancy word for upper floor duplexes, which come at extreme value. So in the UK, traditionally, your duplexes would be considered sort of townhouses and be on the ground and first floor. In this development, they've really kind of looked at stepping up and putting those up on the upper floors to really make them more of an executive experience. So again, this is something that's going to attract your sort of your young professionals or your financial professionals working in city centre, but also wanting to be in, you know, a really, really vibrant location like Digbeth. Okay. And then here we've got our Broadoaks development. So we're actually now launched phase 3, which is great because we've just about sold out on phase 2. Now this location, Solihull, very affluent, established location, going to benefit significantly from what's happening in and around the HS2 in the airport location. But it's already established itself. You know, if you can sort of think of the Constantia of Cape Town, you know, it's been one of the sort of the top locations to live in the UK, voted for a number of years. Again, you've got access to some of the best schools in Birmingham, you know, and those sort of dynamics. So slightly different investment case to what you would see city centre, but you know, fantastic investment opportunity here. We've actually had some studios in this phase 2 that we've rented out to a corporate client, an automotive client, which we've been able to secure a 7% net rental assurance on, because we've got that sort of backing of that corporate client. So again, from our lettings and management division, we have various routes to market where we're able to actually find tenants for our clients. Okay, Mark, if you just run through the photos of that, so you can see. You know, these are, again, you know, the completed units. So these aren't CGIs. You can see the quality that we're delivering within this location. So that should whet your appetite on some of the developments in and around these sort of investment hotspots that we're looking at. And I think hopefully we've taken you on enough of a journey so you can understand really the strong fundamentals, within the market. It's not just certain market conditions that are driving this. There's a number of factors that are really driving this investment case, from the very kind of mechanics of investing in property to the actual regeneration and infrastructure spend that's happening within the UK.
Brilliant. Thanks, Dane. I really appreciate that. It's a very detailed look at some of the hotspots. I know we focused on Birmingham, but as Dane said, we've got developments all over the UK, but this one really is the best business case that we're seeing at the moment. So last little bit from me, I'm conscious of time now. So we've got a number of landlords on the call who probably already have property in the UK and maybe are sat on something that they don't realise, which is effectively a bank account that they could access through an equity release that would then allow them to go and then buy more investment property and start that journey of a buy-to-let property investor. So let me just give you a bit of a quick real-world example. We come across clients that have purchased property in the southwest of London quite often, Wimbledon, Rains Park, etc. And let's say a property there, 3-4 bedroom house, 800,000 pounds. If you've paid that mortgage off, what you've potentially got is a war chest that you could be putting to work to then grow your investment property, like I say, in an asset class that is as safe as houses. So if you were to take that 800,000 pound, only borrow maybe a 60% loan to value, maybe there's 480,000 pounds that could come out from that property, and maybe we could go and buy, another 4 investment properties, maybe 5 potentially, but it depends on where you want to go. And part of our job as the wealth manager is to help to diversify and select those good quality investments. Let's say that we were 6 years down the line. Look, you probably wouldn't want to sell those properties, but even if you did, what it would mean is that you would be able to cash out after all the taxes and what have you with several £100,000 that really you wouldn't have if you just retained that property without any leveraging against it. So this really is, like I say, underlining the importance of considering leveraging and how you can maybe grow your overall wealth using investment property. Okay, so I promised I was going to try and get it wrapped up within 45 minutes, so we're pretty close to that. If you haven't already done so, then please do ask a question on the Q&A button at the bottom of the screen. We'll take a couple of questions now and then wrap up so everyone can get on with their day. Look, if there's anything that you've seen or heard on today's webinar that you like the sound of, you want to have a bit of a more of an in-depth discussion, and don't hesitate to reach out to myself, my team, and then I can put you in touch with the guys at API and talk through what it is that they have in place, what the stock levels and the costings are like, and also, like I say, assist with things like UK-based mortgages. Okay, so the first question I've got here that's just coming through on WhatsApp, and this comes through from Derek. So in a buy-to-let property example, is it realistic to get a loan-to-value ratio, at the sort of 65-70% level? I think that's what you're asking there, Derek. So look, Dane and Shelley, maybe I can pass this one over to you. I mean, I know we've got our own Holborn mortgages team, so we do this in-house. We know that we're getting loan to values at that level. Mortgage markets calmed down a little bit after the stamp duty cut. What's your experience of loan to values and interest rates currently in the UK?
Yes, certainly, Mark. So definitely at that 65-70% level, there's a number of lenders offering to international investors. Interest rates at the moment, we are seeing, again, bringing up your point, it is something that is quite sort of specific, so it's difficult to give a generic answer. But, we are seeing interest rates ranging from 3 to sort of 4.5%, depending on the risk, the geographic location of the client, et cetera, et cetera. So, the great thing with Holborn is that you do have your internal mortgage team, so it's a very simple process to actually get a pre-approval in place at the onset of discussing the investment before even taking it a step further, so you know exactly where you stand in the market, what the options are, what the terms are, to your specific sort of requirement. But to answer the question, yeah, 70%, 65% certainly very realistic in the market currently.
Yeah. Okay. Fantastic. And one other question here from Dave. Dave, thanks again for coming to that discussion we had the other day. So, yeah, look, the question. Sorry, I should actually read it out. It's on WhatsApp here. Is how realistic is it for somebody that isn't a British passport holder to get access to property overseas? So again, another mortgage-related question. I think it's trying to break down some of the barriers that maybe it's perceived as difficult to get access to this, what is relatively cheap primary currency funding in the UK. So Dave, just to answer your question, it's actually pretty simple. That if you've got a British passport, you've already got property in the UK, it makes it easier. But at the end of the day, if we've got a South African national that's never been outside the country, it's still achievable. We do that day in, day out. So we have to really look at it on a case-by-case basis. Okay.
Well, it also ties into the importance of when we're looking at geographically, the places we invest, and going to these sort of legislative structures. It's also the access to finance, right? So we know the UK is very international friendly. With finance, you compare maybe Australia as an example, the property market might be doing fantastic well, but an international client cannot get a mortgage. So, this kind of ties into, again, your triangle of why we've selected the UK for international investors is because it is friendly to those international investors to get finance for them. And, the market really does encourage it.
Yeah, that does underline it, right, doesn't it? If you're only putting a third down, you've got a third of the risk. You've got institutions based in the UK that also know the market. And they're putting the majority of the risk down. So if the business case wasn't solid, they wouldn't lend the money, would they?
Exactly. And it's an important point as a buy-to-let investor, it's a different product to an owner-occupier. So the lenders actually have a different criteria, and a big part of their criteria is actually the performance of the property. So they look at the investment case of the property, they look at the rental income, and they see if it's a viable investment before they actually lend to the client. So further supporting what you were saying there, so the client just has to meet the minimum criteria that from an affordability perspective, but the majority of the emphasis is placed by the lenders on the actual development.
Excellent. Okay, another WhatsApp question here. It'll be the last one so we can wrap up, from Catherine. I think that, again, maybe this is where culturally the differences are being shown, really. So Catherine's asking, is it, we actually right about this interest rate being so low and that we're saying cash flow positive almost from day one? Yeah, we are, and I think, the Brits and the South Africans are very similar in that they love property. The difference is because the cost of funding in South Africa is so expensive, you're probably used to like topping up your property investment, right? It goes negative for the first few years. You have to put a bit more rands in every month and every year. Whereas, in the UK, no, we're saying it's the opposite. Actually, this will probably be, producing some cash almost every month from the get-go, assuming obviously that there's a tenant in place. That is probably the only risk associated with that. You have to make sure that there's a tenant in place. So my last question to you, really, Dane and Shelley, is what's your perception of the demand for rentals, in the areas that you're in? Obviously, you see this when you rent them out through your in-house company. What's the demand there?
So our company at the moment is screaming at us for supply. Obviously during COVID, there was quite an adjustment and a correction to everything. Post-COVID, where our current portfolio that is completed stock is 100% occupied. We have an average letting period over the last 3 to 4 weeks of 10 days. So property being on market for 10 days prior to finding a tenant. These are all kind of great stats that we're looking at. So our team on the ground, like I say, have various routes to market for various tenants, but the market is very buoyant. It comes down to product. It's very product specific. So we are seeing, like I mentioned, those more kind of out of city center locations outperforming the rest of the market, both in rental demand and sort of uptake. But we are seeing city center now obviously slowly recover, with offices reopening and things turning to normal again. But yeah, the market is performing extremely well. Like you mentioned, obviously there's always risks associated, but that's why you've got these professionals on the ground to support you and can talk about maybe adjusting rental values or whatever it is that they need to do to support to make sure that there are tenants in place.
Yeah. Absolutely. And I think I'll leave everyone with my sort of an analogy that I met with a guy that's got a house in Bishop's Court. So he bought it in the 1980s for about 100,000 rand. That property is now worth 23 million rand, so most people would say, he's done pretty well out of that. But then the reason he was quite upset about that choice, looking back, is that he also had the opportunity to buy a place in Notting Hill in London at the time for about £100,000 when it was about 1-to-1. So that property is now worth 14 million pounds. Okay. So that's about 280 million rand. So, strip away everything that we've said so far. Let's come back to where we started around currency and around the importance of the business case, really. But if we take all of that out of the equation, by buying in South Africa 40 years ago, he's effectively ended up with a 12th of what he could have had. He could have bought 12 Bishop's Court mansions if he'd invested in the UK rather than in South Africa. And that really is the message that I want to leave you with today, ladies and gentlemen, which is, if you're invested in property in South Africa, great. We love property, but look, think about eggs and baskets. Why not look to get a toe into a primary currency market, and somewhere like the UK, and in particular Birmingham, with all of its solid business case, is a great place to start. Dane, Shelley, I just want to thank you both very much for your time. It's been great to have you.
Thanks, Mark. Really appreciate it.
And we'll be in touch soon, I have no doubt.
Thanks, Dane.
Thank you, Shelley. And to everybody that's attended, thank you very much for your time. And if you want to reach out to me, feel free on any of the social media channels that you see now. Have a great day.